This is finance, and we're analysing key financial metrics. Let's get into the numbers. In this lesson, we're going to go through the importance of tracking financial performance, key financial metrics to monitor, calculating and interpreting financial metrics, and tips for using financial metrics to inform your strategic decision making. In part one, we've got the importance of tracking financial performance. So how financial performance metrics provide insights into business health. Your financial metrics are quantitative measures that provide insights into a company's performance. They can reveal your profitability, your cash flow, your liquidity, your efficiency, your leverage, and among a lot of other things. These metrics, when monitored over time, can highlight trends and provide an overview of your business's financial health. For example, consistently increasing revenue might indicate a successful sales strategy, while declining profit margins might point to rising costs that need to be addressed. So we can also understand from that as well, as we're in service-based areas, we would know that our gross profit, our cost of sales, is a massive driver to almost identify exactly what our efficiency is. So because we've got billable wages plus materials, less our sales, that gives us our gross profit. And that is a key metric that we want to look at for efficiency measures. Now, the role of financial analysis in guiding business decisions and identifying areas for improvement. So financial analysis involves examining financial metrics to inform business decisions. By comparing actual performance to your budgeted performance, financial analysis can identify areas where the business is over or underperforming. So balancing your short-term and long-term financial goals. While it's definitely essential to track short-term and financial performance to manage cash flow and ensure operating viability, it's also important to keep an eye on the long-term performance and growth. This means considering metrics that reflect the company's financial stability, such as your return on investment and your net profit margin over longer periods. Part two, let's look at key financial metrics to monitor, but let's start with gross profit, and that's measuring the profitability of your products and services. So gross profit is a key profitability indicator, as we touched on earlier, that compares the revenue generated from selling products and services to the cost of producing them. It's calculated by subtracting the cost of goods sold, which we refer to as COGS, from your total revenue, then dividing the result by total revenue. So we can see here we've got sales less COGS equals gross profit dollar value. Gross profit divided by sales equals gross profit margin. You will need to times that by 100 to make it to a percentage. A high gross profit margin suggests your services are being delivered cost effectively and contribute significantly to covering overhead expenses and generating profit. The inverse of that is if you have a really low gross profit, then it would be suggested that your services are not very efficient, and that is a massive massive area for you to begin working on, driving that gross profit margin up. Now, net profit as well. This is also referred to as our bottom line. Net profit margin measures the overall profitability of a business, often referred to, yes, as I've said, as the bottom line. It's calculated by subtracting all business expenses, not just your COGS, from total revenue, then dividing the result by total revenue. This metric gives you an idea of how much each dollar earned is actual profit after all costs have been considered. A higher net profit margin indicates greater profitability and efficiency in managing expenses. A point to remember, though, is that if you have vehicle and equipment loans, these transactions are not factored into your profit and loss statement and your financial forecast. This is because loans on assets, or technically assets, are accounted for in the balance sheet and the transactions are in the cash summary. This is getting a little bit more technical accounting. However, the most important thing to know is calculate your cost per month that goes out to your loans and subtract that from your net profit. And then we call that the operating profit. This is a more true reflection of how much cash is left over after each month. And how to calculate each financial metric using your financial statements. So your gross profit margin, we went through that just previously, and that is your total revenue less your cost of goods sold divided by total revenue. And our net profit is our total revenue less expenses divided by total revenue. Again, the income statement will provide the necessary data. And reviewing your previous period's margins will show you what your benchmark is. Now you have the number to beat as well. So you can go through and look at, for better averages, you may go through and look at your gross profit margin and net profit margin on a quarterly basis over your past few years, whether you've got 1, 2, 3, 4, the more years the better to get the better average. And then use that average as a running target or a number to beat. However, if you run companies like mine that have had massive growth in the past couple of years, we tend to look at our gross profit over the past 6 months, month on month, because that's the truest representation of how our business currently operates. So there's a few ways to go about it, but you will see some consistency as you start to compare your gross profits and your net profit margins. And all you need to do really at this point in time is pick a number to beat, try and beat it, and when you do beat it, then refine your numbers again. So it's just about looking, analysing and reflecting on the data. Now, continuously monitoring your financial performance and making informed decisions. It's important to monitor financial performance, and it's not supposed to be a one-off task. It should be an ongoing process where key financial metrics are regularly reviewed. This can help identify trends, both positive and negative, and provide an early warning system for potential issues as well. By monitoring metrics like gross profit margin, net profit margin, return on investment, current ratio, you get a real-time understanding of your business's financial health and make decisions based on this data. For example, a declining gross profit margin might signal the need to negotiate better terms with suppliers or raise your prices, or it could be a direct representation of a lack of efficiency within your company. So there's a few different outcomes that could be based on the metrics. However, what it does say is that if you see inconsistencies, probe a little further and find the answers as to why. Now, establishing and tracking financial goals to drive your business growth. Financial metrics should be used or should also be tied to the business's strategic goals. Once goals are established, key financial metrics can be used to track progress towards these goals. For example, if a goal is to improve profitability, you could set a target for net profit margin and track that progress over time. If the goal is to improve your financial stability, you could track the current ratio. Regularly reviewing these metrics and comparing actual performance to goals can help keep the business on track and identify any adjustments needed to reach these goals. It's important to ensure that these goals are realistic, they're measurable, they're aligned with the overall strategy of the business, and they are on track to our purpose and our mission. And that's it. We've gone through the key finance metrics to monitor. We know how to calculate a couple of those key financial metrics, and we know how to implement and use and monitor those financial metrics.